after you buy out of a normal base, the first two clear kind of by the book ad positions are bounces off the 10-week lines. Those are the ones where they should work. You can manage your risk at that point, and if they're not bouncing off, something might be off. It might not be a big time winner. Maybe it's just one of those 20% type of winners. That so that's really and I mean, you can even pull up Zoom,
Yeah, I was about to
because
say, give a
I
good
mean, and because
example.
a lot a lot of these rules are really based off you think you are getting in one of the best stocks in the market, right? And so you're trying to do everything you can to add more money to the stock that is working. Like, wow, I really caught a big fish here. Here's Zoom. You can see it had that really big cup coming out, and this is during the pandemic too, right? So right before the pandemic, right before the market really started to sell off hard, it broke out, and once it really got going, there were a couple of points, and that first pullback, and so now it was extra volatile because of this, and so it got a lot harder to do anything during this time. But that first pullback was that security issues with Zoom. Remember all that news
Yeah.
about all the security they can, and so it sold off. It sold off right back to that 10-week line. But as you can see, those next couple of times too, it held on that 10-week line too. So really, all those times right there were, especially the second and third, because I think that's where the follow through day came around, and that's where the market started to trend. Those were two places where you could have added to the stock. So those are kind of your classic times. And then once it got going and took off again, now I mean, essentially that's a flat base right there. But it came back the 10-week line that actually even had a little shakeout right there. But that was another place where you could have added. And of course, once it builds a new position, you can now use that base to really add to it because you're buying out of a new base. So if you just stick with the classic ones, that alone can help you build
Right.
up positions. Now, the other one, the 3 weeks tight, you can add to a little bit there. But I think every day on IBD Live, you guys are seeing kind of the real subtle ones where the guys are looking at the daily charts, they're looking at the little shelves and other little smaller entry points. And I'll let the other guys go into that.
Mhm. Well,
Oh, that's
and
great.
I'm going to just give one caveat here, or kind of a warning that, you know, we often will point out these places where you can add and everything, but you also have to have a limit, in terms of how much of a percentage you want to have in a single stock, and again, I saw Bill get very heavy in stocks before. I saw him, in 2005, 100% in Apple, 100% in Google, on margin, basically, like, that was it. And he didn't start out that way. He always kind of referred to diversifying over time, where he would, not plunge all the money in at once, but he'd start in with a pretty decent sized position, and then he'd be adding to it, just kind of like what Arusha went through. Now, if you get into a volatile stock and you have added a number of times and you have a larger position, just realize that could be a harder thing to hold. If you have a 10%, correction in the stock, which is very normal, right? I'm sure, along Zoom's path there, you had a number of times where it pulled off 10% from its high. You've got to know how are you going to react to that. And Bill would sometimes he'd take a little bit off just in case, and just kind of reduce a little bit, but he'd be keeping that initial core, the lower average cost stock, and that's why he always used the last in first out kind of accounting methodology, because he always wanted to keep track of the decisions that were right, because that would help him hold on to a stock. But in addition to the money that you might be putting into a stock, you also, and especially this became very apparent in this last year, you have to be aware of the appreciation, in the stock, and how much that is increasing your position size as a percentage of your portfolio. With some of these stocks that were going up 100%, 200%, and so on, if you started with a decent sized position, you could have had these stocks easily get to be 30, 40% of your portfolio. And if they were volatile, then that could really be difficult to handle.
Hmm.
So it really depends on your experience level. I certainly wouldn't be recommending for people just starting out. If you've just started out in the last year and you haven't really been through too many corrections, having a an oversized position like a 50% weight in a single stock, that's going to be really tough on you. That's something that, again, I saw Bill do, but that's not for everyone. So just keep in mind that appreciation, for a lot of these stocks is going to get you heavier into the stock just without doing anything. And so you have to kind of keep that in mind, because you
Mm-hmm.
don't want to get so top heavy or so heavily into a single stock that you can't handle the normal wiggles that it might go through. And again, this is something where I feel like Bill was so good at a lot of times identifying, the leader. And, a lot of times, when I would ask him the question, he would say, well, look, it comes down to the one that had the strongest earnings growth. It had something special going on with it, whether it was an industry, that N factor, the new factor, whether it was something in the industry. So like fertilizers, for example. I mean, fertilizers, that's not like a new thing, but when you have something going on in the industry that is different, and that's what we saw 15 years ago, where you had China and India growing their middle class, more food production. You also had the biofuels. So again, when you see some catalyst like that, you've got the earnings growth kind of in there. You've got the price performance. This is something that is doing better than your other names, and so a lot of times Bill would be sorting his portfolio by the ones he's up the most on, and those are the ones that were the ones that would get more money generally. Those were the ones when he was up the most, those were the ones he was trying to hold for the bigger gain. And the other ones he'd start saying, okay, I'm gonna take my profits on these because I want to put more money into the ones that I'm up the most on. And so that's how he would handle it. But again, I just want to caution people that have that level of making sure you don't get too heavy to a point where you
Mm-hmm.
can't sleep at night. You're worried that, oh, okay, if this goes down 10%, that's going to be, I would have lost this much money, and I don't think I can handle that. So again, it's know what your limits are.